Hello, ladies and gentlemen. Hope we are doing well. Hello, ladies and gentlemen. Hope you are doing fine wherever you are. If you have been with me so far, then you need to congratulate yourself. You are actually making it towards passing the ACCA financial management paper. All right. If you are also doing the ACCA Foundations Financial Management paper, which is part of the ACCA CAT qualification, you are also doing yourself a favor watching these videos. I just want to congratulate yourself. You are doing the right thing. If you're finding the videos very useful, please don't forget to like, share, and comment and subscribe to the channel. Okay, I am Jeremy Timkulu and welcome aboard. Let's proceed. Now we want to venture into something more mature, working capital management, the second stage. We have been dealing with a lot of issues so far. Okay, we've been looking at business which are meant to make profit and businesses which were meant not to make profit but to satisfy other motives, other objectives. All right. Now, please bring your attention to the profit making sector. That's what we are about to deal with. All right. So, hang on. Now, the lecture objectives. In this lecture, we are going to cover two aspects of working capital management. That is, inventories and payables and receivables. All right. These are the two things we are going to look at. Now, inventories. The purpose of this part of the lecture is to examine how we are going to manage inventory efficiently. The two most important approaches are the economic order quantity and the JIT, the just in time. Now, why do companies hold inventories? There are three reasons. One, to ensure any unexpected demands can be met, thus to meet erratic demands. So we keep a certain level of inventories such that when demand booms, we are not going to be found wanting, right? So we will be able to meet that demand as it comes. Then, to meet any future shortages, sometimes there could be some stock outs, even at the wholesalers. So we are not going to be out of business because of such scenarios. So we need to keep some inventory that will give us some enough headroom to counter such shortages. Then bulk purchasing discounts. If we buy a lot of inventories, we are likely to enjoy some bulk purchasing discounts. Now, when we are talking of ordering inventories, there are three costs we have to think about. The first one is the purchase cost. This is the actual price which is going to be paid when you are procuring a product. Okay, the actual purchase price of the commodity. This price is usually not relevant in our computations unless it gives rise to some purchase discount. Other than that, if it is just the ordinary fixed amount, then the cost is considered irrelevant. Now, the following two costs, the reorder cost and the holding cost, are considered relevant. All right? Reorder cost is the cost of actually placing orders. It includes such costs as the administrative time, okay, the administrative time in placing an order and the delivery cost charged for each order. If there is a fixed amount payable on each order, then higher order quantities will result in fewer orders needed over a year and therefore a lower total reorder cost, over a year. All right. So if there is a fixed charge, like for example, whenever you place an order, you pay $100. Then it means that you need to then cut on the number of orders in a year. If you were ordering, if you're making 50 orders in a year, it is actually advisable to reduce the order by purchasing more quantities. Whenever you are making an order, you just have to purchase more quantities. Why? Because there is a fixed charge. Whether you buy 30 tons, you're going to pay $1,000. If you buy 10 kgs of the material, you're going to pay $1,000. So it is better, it is advisable to reduce the number of orders, but to increase the quantities. But watch out, there is this other cost called inventory holding cost. This cost is going to limit your choices or your quantities, okay? Because you need to think of how are you going to secure the order? How are you going to secure, the inventories after ordering it? So inventory holding cost is the cost of holding items in inventory. It includes costs such as warehousing space and insurance, and also the interest cost of money tied up in inventory. So you'll be worried about the warehouses, the security people who are going to guard over the inventory, the insurance, the electricity, the energy to keep the inventory in good state. Higher order quantities will result in higher average inventory levels in the warehouse and therefore higher inventory holding costs over a year. So you need to watch out. In as much as you want to limit the reorder costs, you have to think of the holding costs. All right. Now let's move on. Cost minimization. So we're going to do this example to understand which quantities should be able to leverage or to leave us at a better cost position. Because remember, we need to cut costs as far as possible. All right, we need to reduce costs. All right, so Janice has demand for 40,000 wardrobes per annum, and the purchase price of each wardrobe is $25. They are ordering cost of $20 for each order placed. Inventory holding costs amount to 10% per annum of inventory value. Calculate the inventory cost per annum for the following order quantities and plot them on a graph. So we have already mentioned that the purchase price is irrelevant. However, it can be relevant where we are having some discount or it is linked to some purchase discounts of some sort. So in that case, it becomes relevant. However, in this question, there are no purchase discount. So the only way, the only moment we are going to make that value relevant is when we consider the computation of certain variables. Like for example, we are told that inventory holding costs amounted to 10% per annum of inventory value. So therefore, we will use it for the purpose of computing inventory holding costs. Are we together? Thank you. So calculate the inventory cost per annum for the following order quantity. So we are given 4 quantities, at 500. How much will be the total inventory cost? 750, 1,000 units, 1,200 units. So, okay, so I need to come up with a table. All right, let me just try to create some lines, some rows rather, so that my figures will be organized. Okay, some columns. All right, and the first one is the order quantity, the order quantity column. All right, and then the number of orders, all right, and then we need the reorder cost. Reorder cost. The cost of placing an order. All right. And we have been told in the question that the reorder cost is $20. So we can just simply put our $20 there. All right. Then we might need the average inventory. Okay, we might need the average inventory. Average inventory. We might need that one. All right. We might as well need some stock holding cost per annum or inventory holding cost. Okay. What's the shortcut there? I mean, okay, we can just say holding cost. The holding cost, it's per unit. Well, let us put it as per unit, right? Okay. Okay. Since in the question we are told that it's per annum, 10% per annum, so we can just leave it at per annum. However, I wanted to emphasize that the holding cost per unit matters first for us to arrive at the cost per annum. So per unit, we are told that it is 10% of the inventory value, which was $25. So per unit, we are going to see that 10% of 25 is $2.50. This is per unit. All right, and then since we have the reorder and holding cost, obviously we are going to have the inventory cost as the final figure or final column. All right, so let us fill in the details in the columns. Now, if we are having a demand of 40,000 wardrobes, and we are only ordering 500 units each time we make an order. So it means that the number of orders will become 40,000 over 500 units. And this should give us how much? 5 into 40, that's 8. Okay? And there is a 0 remainder there. So we are talking of 80 orders. All right. Then the reorder cost becomes how much? Because we are told that to place an order, you are going to pay $20 per order. So 20 multiplied by 80, it becomes 1,600. Okay. What about the average inventory? Since we are making orders of 500 units, average inventory becomes 500 over 2, which takes us to 250. What about the holding cost per annum? If we are ordering 250 on average, it means that the holding cost will become 250 multiplied by the cost per unit, which was $2.50. So multiply by 250. This will lead us to 625. So this becomes 625. Now, the inventory cost will become, remember, I said that the inventory cost, the relevant cost is the reorder cost plus the inventory holding cost. So those are the two costs. So we come here, we want to add 1,600, which is the reorder cost, plus 625, which is the holding cost. And this gives